Hello, everybody. Kirk Spano here, and we're going to run through some macro and some oil because energy is one of the key components to inflation, which is what we are supposedly fighting. Now, as you know, I think that deflation is the big boogeyman. I think it has been since the early 2000s, probably 2005, 6, 7, 8 into the financial crisis. And counter-cyclical policy from the monetary side, plus the three big bailouts, each one successively larger over the last 20 some odd years, have been what has created the inflation in general from the policy standpoint. However, the inflation that we've had for the last 2 years, roughly, has come from actions specifically tied to an event, COVID, that allowed OPEC, Russia, and China to manipulate the international trade system. We've talked about this over and over again. I think that it's time to be very, very succinct about what is going on because people just ask the wrong questions. People want to gravitate towards Milton Friedman that inflation is always and everywhere a monetary phenomenon. That's just wrong. There are inflationary and deflationary pressures in the economy that are exclusive of monetary or fiscal policy. Monetary and fiscal policy are the responses to those economic pressures. What are those economic pressures? Aging demographics is the biggest one right now, but technological advancement, which is typically disinflationary, is also out there. And rampant debt spending, the accumulation of massive debts, which theoretically have to be repaid someday, are also deflationary or disinflationary. Now, those two terms are a little bit different. Disinflationary is just really fighting inflation. It's an offset. Deflationary is its own force, like aging demographics. But this is really the crux of it all. Bear markets rarely, if ever, end without a capitulation. Now, there was a recent example where we didn't have a panic-based broad sell-off, and that was the 2014 to 16 stealth bear market, where stocks essentially chopped sideways for almost 2 years. That period gave valuations a chance to come in because prices stayed about the same, but earnings went up, a reduction in the price to earnings ratio. And then we saw a bull market from 2015 to 2017, almost 3 years, before we got the volatility events of 2018 that resulted in a slightly down year. 2019 was looking like it would be a choppy year until the Federal Reserve started to bail out the repo market and pumped about $1 trillion into the repo market from September of 2019 to February of 2020. Of course, in 2020, COVID came into the picture. I had posted on Twitter back in January it was the most important story in the world. Everybody ignored me or said I was stupid. I issued 2 alerts that said sell almost everything. Again, ignored and told I was stupid. And then the stock market crashed in March. And that was a capitulation event. And the question I've always asked was, how low would stocks have gone without the gigantic, biggest in history, monetary and fiscal interventions ever? And I asked at the time, why are we printing more money and pushing more money into the economy than what was lost? I thought it was an important question. So I'll come back to it today. The economic losses to the global economy were about half the amount of bailouts that came. So the bailouts were roughly double what the losses were. Why would we do that? Fear, stupidity, or evil genius? To never let a good crisis go to waste. What have we known for decades is a massive crisis that's coming. It's something that you should be very aware of. If you're a baby boomer, it should be very acute to you. We have a huge retirement problem, not only in the United States, but in Japan, in China, in Europe, and other parts of the world. There are billions of people right now, about a third of the global population, that are retirement age, senior citizen age, or just about to get there. How do we support them? Remember back when Social Security was started, there were 10 people working for every 1 person on retirement. And those people who retired were only anticipated to live 5 to 10 years in retirement. Today, it's roughly 2 to 1. and the folks in retirement are going to live 20, 30, and in some cases 40 years, but really 20 to 30 years to be expected. So far fewer people putting into a system to support the retirees who are going to live 2 to 3 times longer. And we've known about this basically since the 1960s. And we've done nothing about it until the 1980s with some very minor tweaks. And then again in the 90s and the 2000s, every president has made a small tweak, every Congress. And yet we still weren't remotely prepared. Along comes COVID, random act of nature, probably, maybe, who knows? Who cares? What difference does it make? And we create double the bailout that we needed. I argue that that money was created and pushed into the system specifically to help the baby boomers retire. What have we seen? We have seen inflation because of the rise in home prices that resulted from the work from home remote economy that surged in 2020 and all the easy money that was out there to go and buy properties. You have millions of people, tens of millions of people locked into their mortgages now because the interest rates are super low and the property values are starting to come down. Last year, property values lost $2.3 trillion, the biggest decline since the financial crisis. And this year will be similar. That's one aspect of inflation and a major driver to the domestic economy. The next biggest driver to inflation has always been oil. And from a demand standpoint, there really is no growth in demand for oil over the longer rolling time periods, about 1% per year for the last 15 years, maybe 1.5. So below the rate of inflation. But COVID allowed OPEC, Russia, and now China to manipulate inflation. China needs inflation to get out of their demographics issue. Putin, little Vladdy, is just a piece of shit, fighting old wars, creating new wars. And OPEC, they know, because they're already planning for it, that the end of the oil age is upon us, that we are within a decade of seeing massive demand destruction for oil. And they need that money. So they have manipulated the price of oil higher. And then Russia created the shock. And they were able to do it because so many oil companies in the United States went bankrupt under the Trump administration. People look and are like, well, how could that have happened? He was pro-oil. Not really. Says he was, but not really. In 2018, there were supposed to have been more sanctions placed on Iran, backed off on doing that. And if you look at the charts from autumn of 2018, you see the price of oil dropped. Take a look at the number of oil companies that went bankrupt from 2015 to 2020. There's basically 3 waves of bankruptcies after OPEC flooded the market with oil, when Trump didn't sanction Iran, and then with COVID. So you had this big wipeout of wildcat oil producers in the United States and a big wave of consolidation. And we had to bail out the oil companies in 2020. So they went from needing a bailout in 2020 to having record profits in 2022. Now, if I were Joe Biden, I wouldn't just piss and moan about war profiteering and anything else that he's saying. What I would say is I'd say, look, when COVID hit, you guys needed a bailout and we helped bail you out. We refinanced all your debt and created a tax break that allowed you to take previous losses and put them against more recent gains. And so a lot of companies restated their taxes and wiped out tax liabilities. Fast forward just 2 years later, they're making record profits. What I think Joe Biden should say instead of your war profiteering is, hey, we bailed you out. You're making a whole bunch of money now. Pay it back. You can pay it back by producing more oil for a while. Maybe let's do a contract to refill the strategic petroleum reserve, or write a check. We don't care. Instead of buying back shares, send some money to the Treasury. How do you want to handle it? We'll get the law passed. Now, that takes a lot of explanation. And what we know historically is that politicians who explain things lose. So it's better to just harumph. My team, my team, my team is what works in politics. It's what gets people elected. And that's our fault for being shitty voters. Why is that important? It's because it affects what's coming next in the markets, and it gives you a really good investment opportunity. And you know that I'm heavy into the energy transition, but there are times to buy oil stocks, and right now is probably another one of them. So the Fed is fighting the potential energy inflation and has almost already won the war against home inflation. Another year of rates being in this range, they only have to really go higher. They go a little higher, then come back. But if a year from now, interest rates are about the same, which I think is probably a pretty good guess. That still is a lot of pressure on real estate, which means that we probably have a couple more years of housing prices not really going up anymore. And the resets on commercial loans bringing down the price of other types of real estate. Somebody asked me in the comments yesterday of this article what I thought about apartment REITs. And I said this: from my experience with private equity firms that I've been talking to and family offices, here's what I think. I think most apartment REITs, which are big, have problems. Why is that? Because the argument always back is, but people need a place to live. Yeah, whatever. Doesn't mean they have to live there. We have malls and mall areas all over America and other property types that are being redeveloped into mixed use, which I've been on top of for 15 years. Mixed use communities are the future. You've only been seeing it happen now from mixed use buildings to mixed use neighborhoods last 4, 5, 6 years, right? Remember downtown, somebody would build a building and there'd be retail on the first floor, several floors of offices, and then condos above. That's changed to now they're taking the big hunks of land, which are a lot of the decrepit mall areas and other hunks of land, and they're putting in a mix of grocery stores, restaurants, shops, and housing. Great example of a couple of them in the Milwaukee area and all over the country. I've seen them all over. The people who invest in those sometimes are the REIT companies, but that's an expense for them. It doesn't help them a lot in the short term. A lot of people who are building those are developers in the city themselves with private equity and family office money. So those developments are sucking away the renters, the upper end renters, right? The ones who keep the rents high, and they're moving to these other areas where they can just walk outside, walk their dog, go get a taco, buy some food, need a new shirt for my date tomorrow night, whatever. So a lot of the apartment REITs are in trouble. That's the hard one with the REITs. The easy one with the REITs is that the offices and the mall REITs are still in trouble because occupancy is low and rents have started turning down. And that's in the face of having to do their reset on their loans, which they have to do about every 5 years in almost all cases, 5-year resets. They don't have 20 and 30-year loans. They have 5-year reset mortgages or notes. About 20% of all the commercial loans in America get reset every year. This year it's 17%. Next year and the year after, it's like 22 and 23%. So this year and in 2024 and 2025, you have about 60% of all the commercial loans getting reset at higher interest rates. So if their occupancy is lower and the rents have stopped going up, which they have pretty much universally, and in many cases fallen, see a lot of rent specials now in apartment buildings, which we hadn't seen maybe for a decade. How are they going to be able to afford those new mortgages, which are 3, 4, maybe 5 points higher, and still make their big fat dividend payments? It's difficult. There's a lot of REITs out there that are going to get crushed. They're only halfway done from what I can tell. They haven't had the fall off the cliff moment. I've talked about the falling off the cliff moments that are coming and that have been happening. Really, it started with the small caps. You now have to sort out the real winners from the real losers, the real quality from the real mediocre and the bad. Which companies, in George Costanza lingo, have shrinkage? Companies that have shrinkage are not going to rebound. They're just being reset lower, and that's not going to come back. Now, if there's a monetary flood of money at some point, they'll go up temporarily, and then they'll go back down. I would say, like I've been saying for the last 15 months, sell them while you can, regain that time on your calendar for investing, or you can wait for the next time the Fed is loose, which might not be, for 5, 6 years, whenever the boomer crisis really takes off. So what is the Fed fighting right now? Housing inflation, they're winning. Energy inflation, they're holding their own right now. They're keeping the dollar pretty firm. It's fallen back a little and then jumped back up. Hasn't set a new high yet. I think it might, because they know that Russia is going to keep disrupting. They know that OPEC's not going to pump more. And now China, according to Scott Sheffield at Pioneer this morning on Bloomberg, which I gave you a note to watch on the chat room, he says that demand for oil globally is going to increase 800,000 barrels a day this year just on China. So that demand that they didn't have the last couple of years because of COVID-0 now is coming. So why is China buying up so much U.S. oil? That's why. So the fight that the Fed is fighting right now really has graduated to we have to wait out the pressure on inflation from energy as long as we need to. And what year do we keep coming back to when that upward pressure on energy inflation, right? The upward pressure on energy prices, energy inflation, is going to really start to dissipate. I want you to have this in your head. I want to see 50 people answer on the board right now. There you go. It is now open. What year are we expecting there to be a realization by the market that demand destruction for oil is coming? And why is it 2026? Because by 2026, the supply chains will all be built out. All the factories will be producing EVs. ICE vehicle production is disappearing. EV production is ramping up fast. And in 2026, the mileage requirements go up dramatically. So selling an ICE vehicle that's not classified as a truck becomes ridiculously daunting for a car manufacturer. Their fleets have to have a certain mileage. Back in 2020, when I was at CES and I reported back to you, the executives were saying that starting in 2026, there is no way technologically to make an ICE vehicle efficient enough to sell more than a couple of them. So what you're going to start seeing after 2026 is that companies that build gasoline cars or diesel cars in a handful of cases are only going to build a handful, and they're going to be expensive. If you want a muscle car, you better buy it before 2026 because the price is going to go up dramatically, and it might go up by next year. At the same time, the price of EVs is coming down and there's tax incentives. So because a sedan for an EV has to be priced under $55,000 to get the tax break, that's what they're doing. They're maneuvering to get anything that's classified as a sedan, so basically a mid-size crossover and smaller, $55,000 or less. Well, suddenly those EVs, which are way better than the ICE vehicles in most cases, they're faster, they're safer, they're smarter, they're bigger on the inside of the cabin because they don't have to have the exhaust. They run for 300 to 500 miles now on a charge. They're smoother, they're quieter, they smell better. That's not even a joke, right? No exhaust underneath you seeping up through the welds. So if you can get an EV for $40-something thousand after the tax incentive, say a Model Y or a Mustang Mach-E, why would you buy a $30,000-something ICE vehicle that's not even close to being equivalent? You wouldn't. And all the sales numbers show that. Sales growth for EVs is already over 10% year over year, and that's just going to keep happening. The grid is being built out to support that. There was just some headlines on that recently. The batteries are getting better. What did we see from Enovix today or yesterday with their earnings? You are right on top of your last best chance to recognize these trends, or you'll just turn into a FOMO investor in a few years and you'll miss the big early moves. Right now, though, because OPEC is winning by keeping the price of oil higher and the consolidation in the American market has prevented a giant surge in production, we are going to set a record this year. Sheffield said it would be at the low end of the range that people are expecting. EIA says a jump from 11.9 to 12.4 million barrels a day, which would break the record, I think, by 100 or 150,000 barrels a day. He's saying the low side of that. So it might end up only being 12.3. It might essentially tie the record. Still be an increase, but not enough to offset 800,000 more barrels a day from China demand. So the Fed's going to fight that energy battle until it doesn't have to anymore. I think the markets recognize what's going on about a year and a half from now. After the 2024 drive season shows that all the new EVs are starting to have an impact. And again, go back to COVID and think this through. Hardly any new cars or new leases especially were taken in 2020 or 2021. That's why there's a shortage of used cars. Now, new car production has ramped up and then fallen off and then started to ramp up again. So it's choppy. It's lumpy. That scares people. Used car prices have come down off their peak, but they've pretty much stabilized again. There's a sort of equilibrium there. So what you see for used car prices right now, probably what you're going to see for the next year, year and a half, maybe 2 years. But then the leased cars from 2022 and 2023 will start getting into the used car market 2024, 25, 26. Again, leading right into 2026. So what I'm going to tell you to do today is I'm going to tell you to buy some oil stocks. However, that is not a universal recommendation to buy oil stocks. As we talked about last week and over again, to buy a fossil fuel stock, that company has to have a energy transition plan or just have incredibly cheap assets. I'm going to give you one of each today. Companies that we've been in, but right now the price is right. So I wrote this article way back in December of 2021. Take a look at what I said. Back then, what was there? There was people saying, right, the narrative at that time was the Fed was going to have the stock markets back for not forever. The Powell wouldn't maintain his hawkishness, that stocks wouldn't fall. So I'm not so sure about that, right? Inflation is a scary boogeyman for voters and politicians. And I said the Fed tightening will force prices down across the board. That's what's happened. Ultimately, deflation is still deflation. Is still the long-term demographics, debt, and tech-driven boogeyman that the Fed will fight again. Not sure when. Whenever the boomers start to hurt too much. Whenever there's a credit crisis because things just aren't working out for them. Now, 5 years out from now, and I'm not going to go through all that today, but about 5 years out from now, 2028-ish, 9-ish, towards the end of the decade, is when that shit probably hits the fan. Between now and then, we have money to make. And as the dollar comes down, because the Fed no longer has to fight energy inflation, probably starting in a year or two, we're probably going to get a heck of a bull market. It'll be in the face of pessimism and narratives until the narratives flip, and then we get FOMO. It's the way it always works. I'm lucky that I had a Chicago Board of Exchange trader in the family who told me all this stuff back when I was starting, that it just repeats. So we haven't gotten capitulation yet, and maybe we won't. Maybe we'll get a 2014-16 choppy market to make valuations come back in. I don't think so. I don't think there's time. I think this market just bottoms out sometime this year, and then we start the presidential rally as the Fed finally pivots, or at least pauses later this year, and maybe even does a rate cut or two in 2024. Nothing like a good stock market rally for the president. Now, small caps, I still think that's where the value is because they got crushed and they've stabilized for the most part. When I wrote this article, I started by talking about something that somebody said in the comments from the prior article. The prior article to this macro dashes was inflation is transitory, most prices are permanent. So the inflation is going to go away in the next few years. I really think falls off after Labor Day. I think we have like a 2.9 inflation rate after Labor Day, right? We'll inch into those twos, and that'll be enough for the Fed to pause. Because Mohammed El-Arian and a bunch of other people are saying, if we get it all the way down to 2%, we'll actually have unemployment again. We don't need unemployment. We need immigration. Because who's going to take care of all those old boomers in 20 years? Told a daughter who's in the friend group who's talking about getting into nursing. I said, if you can do that, you're going to get rich. And if you get some sort of business degree on the side, you'll get richer. A nurse with an MBA or physician's assistant with an MBA, holy cow, are they going to be able to make money running hospitals in the future? Because the way AI is being incorporated and remote doctoring, it's going to be amazing when the healthcare deflation sets in. Somebody argued with me about that in the comments of this new article. One of the things that we have to expect for down the road is healthcare deflation. If we don't get healthcare deflation, then all my projections about a massive boom in the 2030s will probably be wrong. But technology and some immigration is all it's going to take for there to be healthcare deflation. Healthcare is way too big of a part of the economy right now, especially for the outcomes. We spend roughly twice as much on healthcare as other developed nations, and our outcomes are worse, except at the very high end, right? If you're rich enough, you can buy your health, until you die. Anyway, so it was November of 2021 where I said probably take up to 2 years for inflation to get under control. Well, that would make it autumn of this year, which I've stuck to. Well, this guy says, I am sure you can figure out 2 years would be horrible. 2 years of inflation? Wow. Or 2 more years at that point. It had already been a year into it. And I do understand, right? I grew up poor and then middle class. I've been between middle class and upper middle class and sniffing 2%-ish on and off. Yeah, I'm never going to get to 1%. Maybe I will. We'll see how the hedge fund goes. But inflation in the short run is usually bad because it's usually accompanied by high what? Unemployment. We don't have that right now. So even though prices have gone up, as long as everybody has a job, you probably have 80% of the people with a job who are hanging in there. Doesn't mean they're getting ahead, but they're hanging in there. Most of the numbers show that too. But we still have only about 20% of the people really getting ahead at all, right? And by ahead, I mean are going to be able to afford retirement. You still only got about 2% of the people who I'd say are getting to be quote unquote rich. And the second of those 2% isn't really rich. They're just comfortable. Only about 1% of the people really get rich. And then some of them get really, really rich. So when inflation stops, maybe, it gets down to a reasonable rate by the end of this year, the Fed should pause. But that doesn't mean that there's going to be more supply to the economy in the short term. So there will still be upward price pressures until energy is not a problem and the supply chains have finished moving. All of those things are happening over the next 3 or 4 years. And most of it is adequate by after Labor Day 2024. Why do I always mention Labor Day? It's because that is the natural transition for the economy. It's after the vacation and driving season. That's when the energy numbers really change each year. And with the planet getting warmer, winters haven't been as harsh. So a lot of things really are measured by how many highway miles we're driving. And as those highway miles shift from ICE to EV, that relationship will change too. So energy stocks just tumbled because crude oil inventories went up. And I'll remind you that the Strategic Petroleum Reserve by law that was written in like 2019 or something has to sell whatever it is, 38 million or 36 million barrels this year. And they're going to do it. They're not going to not do that. So we're going to be selling oil from the Strategic Petroleum Reserve into the summer market this year and next year. Now, some Republicans want to not do that. There's not really a reason to not do that. It doesn't matter that the Strategic Petroleum Reserve is getting lower. It's not low, still 380 million barrels, 380 million barrels. And in a few years, what's going to happen? We'll just refill it. Not because we probably need to, but we'll refill it as a matter of course, get it back up near maximum capacity to help the oil majors, which we always do with their energy transition. Hey, we'll buy oil from you to refill the SPR while you transition. But that's going to be it after that. So you're going to be down to these few years to refill the SPR, and then you better have a plan. And that's why I tell you, you have to invest in fossil fuel companies with a good energy transition plan. Russia's offensive is on the way. Prices are probably going to start going back up. Summer driving season is on the way. China demand is on the way. Pioneer says, he said this about 2 hours ago, oil's going to get to around $90 a barrel this summer. I believe him. Scott Sheffield over at Pioneer, I think is the best oil man in America. So some of our oil stocks. Permian Resources stock climbs as fourth quarter output tops estimates, and their margins are great. Created a dividend. They're going to buy back shares. Stock is still right around $9 or $10 a share. When you take a look at the numbers on this company, remember, these are the guys who took private equity firms, started buying bankrupt assets, then merged two other companies at discounts. This is a company with no net debt, oil company, no net debt, and cheap assets, cheap rock. Somebody mentioned that in the chat today. I'm glad that it's starting to sink in. Having good rock, that's what it's called in the oil industry. If your rock is good and it's cheap, you are golden. Permian Resources has that. I still think they're going to get bought, but it'll depend on what's good for the executives, right? So when the executives can get the most money for selling, that's when it'll get bought. Permian Resources is one of the stocks we're going to get into again, or more, I should say. Occidental was cut to sell because of why? Because they're going to buy back $10 billion worth of preferred shares this year. These are the shares that are owed to Berkshire Hathaway. So basically, Berkshire Hathaway is going to get a $10 billion infusion from Occidental. And what are they going to do? Into that dilution, which is, I think, how they're going to do it. They might just do cash. Occidental is just going to buy more, Berkshire is just going to buy more shares of Occidental. How do we know that? Because Warren Buffett said he's going to do it. Berkshire's ownership of Occidental went from 21% in Q3, 28% in Q4, and they're cleared to go up to half. Remember, they still have warrants. So Berkshire is going to end up buying Occidental just by virtue of getting to close to half of the shares owned anyway. And they'll have to work out a price. I'm going to show you about what the price is going to be because there's a calculation. So at the same time that these guys are downgrading Occidental because of the preferred shares that they have to buy back, Goldman is ramping it up. They previously had been at $74 a share. Goldman's at 81. Stock's trading at 59 or 60 today, which is the warrant price. Let's look at some numbers. Look at the gross profit. Jumps on the Anadarko acquisition, falls during COVID, then starts to ramp up. $24 billion they made last year. Crazy, right? Let's take a look at their debt. About $20 billion, down from $30 billion. They're knocking out $10 billion a year in debt. So they're going to have a profit over $20 billion again this year. They might not quite break $24 billion, but let's say 20 something billion, low 20s. So that means they can buy back $10 billion of the preferred and knock out another $10 billion in debt. Vicky Holub has said, she's the CEO, that they're not really going to increase production. They're going to keep it about steady, maybe go up a couple percent. So no really new expenses. Let's compare that to Pioneer. Pioneer is trading at $200 a share. They have 237 million shares outstanding. Occidental has 900 million, right? So that should be what, 2.5 times more in price. The companies are both at about $50 billion in market cap, and Pioneer earns $10 billion less. So when you divide the numbers of shares by the earnings, you try to figure out, okay, how do these two companies equate? I'll do the shorthand math for you. Occidental should be around $120 a share if they get all the same valuations as Pioneer. Now, Pioneer has a great valuation because they are super low debt. Occidental is about to become super low debt, and then Berkshire is going to buy them. So I don't know if this stock quite gets to 120 because I'm sure there's some discount. But if Berkshire has bought the majority of their shares at $60 and lower, and they have to pay 120 for the other half, average price of 90, that's still a 25% discount to intrinsic value. I don't think they'll have to pay 120. I'm sure there's an Uncle Warren deal in there somehow. I'm sure Vicky gets paid off very well. I'm sure that these thoughts were in everybody's mind when she cut the deal with Berkshire in the first place. She's not dumb. She knows that Berkshire buys whole companies. So the top end for Occidental appears to be around $120 a share. Probably doesn't quite get there, but it's 60 right now. So the Occidental trade I'm making is very simple. I am selling the puts as often as I can. We know that $60 is a pretty hard floor on that one. So I am selling the May $60 puts. I've done it already today. I already posted in the chat rooms. I'm selling the May $60 puts for around $5. Always ask for the ask and then walk it back a nickel at a time every 20 minutes until you get your price. Today, the market started out strong and it's been weakening. So I think you're going to get 510, 515, 520, something like that. That's over an 8% return for 3 months. The downside is that you have to have a net cost on buying Occidental at around 55, which is below the warrant prices. If you're really aggressive, you could sell the 65s. And if the stock price actually goes up past 65, you capture a lot more. But if you can make 8% every 3 months selling puts on Occidental until they get bought out, that's 32% plus a year. Can you live with that? Can you live with making 32% a year? So I essentially have a double position in these puts now. If it gets put to me, Occidental will be 7-8% of my portfolio and about $55 a share. I can live with that because when it gets up into the 70s or 80s again, and it will, I can sell covered calls. But I think that this is a pretty good strategic move, is selling those puts because the volatility of oil allows you to do it. Now, the one that I want though for growth is Permian. This company, let's take a look at their balance sheet. I'm just buying the stock here. I'm also selling puts, but I have a full position in this one now. Take a look at their financials, right? It's a smaller company for sure. Making over $1 billion a year right now. Have over almost $2 billion on the balance sheet. Oh, well, that's the next one, but that's what they're going to have. Take a look at, balance sheet. Yeah, some cash on the books, plus that billion that's coming in, $1.3 billion long-term debt. They can almost pay off, and it's because they acquired Centennial. Think of the curve that I just showed you with Occidental. Debt went up and then it came down. Same thing's happening here. They're going to be able to knock out around $1 billion of debt, and they just declared a dividend. Maybe by the end of next year, this company is debt-free, but it should be at least net debt-free. It should have more cash than liabilities, than long-term debt. How many net debt-free oil companies are there? Not many. So that makes this one a big buyout target too. And when you do all the math on it, this one comes out to around $30 a share. right? It's trading at 1062. It's up 15% today. Buy the dips on this one. I've been telling you to buy the dips on this one for a long time. So when it goes back into the nines, and it probably will, maybe even tomorrow, buy it and sell some puts. Sell $10 puts or $9 puts 2-3 months out. And then right before summer driving season, do it again. These are all pretty easy winners with very limited downside, at least for the next couple of years. I don't think I want to own these by 2025. I mean, I don't think that these are 10-year holds. Occidental gets bought out by Berkshire, take the cash and redeploy it. Pretty rare that I don't know that they've ever paid in Berkshire shares. But if you get Berkshire shares, then you can just hold on. And I don't know who's going to buy these guys. My guess is Chevron or Exxon or BP. Maybe. We'll see. BP wants to get it back into the Permian. I don't think they will. I think Chevron or Exxon is going to buy these guys. Or maybe Berkshire folds these guys into Occidental. What's the backdoor play for these companies in Texas to have all those caverns underground, all those oil caverns, salt caverns, carbon capture? That's right. And Occidental is a leader in carbon. This company's getting in there too. They'll probably mainly get in when they're acquired, right? So if Chevron acquires them, which is the very logical one because they're going to be the biggest carbon capture company in the world, they're just so big that it might not move the needle a lot, but it'll keep them humming. We'll see what happens with Exxon. Exxon suddenly has the money to buy these guys. So these last little companies are going to get bought. I think this is the best one. They have the best assets by far, least amount of debt. I think it would actually take $30 a share to get these guys. But I think this one's a pretty easy one. Buy the dips on this one. Anytime it's under 10, you should be buying it. Probably not a horrible idea just to sell the puts right now and buy it. So, all right, let's call it a day. Let's understand what the Fed is really fighting. The Fed is filling that gap of time between now and when oil, energy, inflation isn't that big of a threat. Probably 1.5 to 2.5 years from now. Hard to know precisely, but we have a little window here between now and I'd say the end of next year where these oil stocks should do pretty well. And the reason I sell puts is because then I don't have to commit to them long term. I get to make my decision every quarter, right? All right, have a great day, and I will get a couple of articles written this weekend. I am skipping my World Series of Poker Circuit event down in Chicago this weekend to catch up because I fell behind when I was in Las Vegas. So I owe you quite a few articles, and I will crank those out as quickly as I can. One of them is titled AT&T is a great retirement stock again. So you can look forward to that. All right, have a great weekend, and let's keep an eye on what happens Friday.